Hello students and welcome to the lecture. So students, as we know that we are covering the general awareness and basically what we are discussing about the static economics. All right. And in the last lecture, what we have started our discussion over the monetary policy, right? That's what we have started our discussion upon. All right. And whatsoever we have completed the overview, we have completed the interest rates, we have completed the money supply and the exchange rates. All right. So what we will do, we will just try to recap before we go ahead. All right. So basically, if I am asking you about the monetary policy, about monetary policy. All right. So what do we mean by when I say we are talking about the monetary policy? So in the previous lecture, I had told you that the monetary policy is basically related with the money supply, right? Okay, it's basically, you can say, defines the household, businesses, government. Okay, this is the economic cycle. All right. Okay, so this is just like an you can say economic cycle. Household to business, business pays tax to government, government spend it on the household. Okay, similar thing. Business sells their products to the household, household purchase and paying indirect taxes to the government, and government provides various subsidies and provisions to the business houses. Okay, so this is the money flow in the economy, right? This is the money supply. Okay, and which organization of the country is responsible for the central bank of our country? Okay, and in the context of India, if we are talking about the Reserve Bank of India. Got it? So basically we are talking about the Reserve Bank of India. All right. Secondly, if we're talking about the tax rates, what we have discussed in the tax rate, we have discussed the repo rate. Okay, and what was the repo rate? Repo rate is basically the percentage of interest which is chargeable on loans from the central bank, right? Loans from the central bank. That's what we have concluded in the repo rate. All right. And we have also concluded that the normal citizen could not directly go to the Reserve Bank of India and takes a loan. It's basically the part of banking operations and the financial institutions. All right. They takes the loan so that they could fulfill their loan department applications. All right. As I have shown you that there are people, then this is the bank. Okay. When the banks grant the loan to the people, so its reserves goes on decreasing. All right. So in order to maintain the particular reserve, the bank takes the loan from the central bank. All right. If the percentage charge on that loan will be higher, so the bank eventually has to take a higher interest rate from the loan borrower. Okay. So the person who is going to borrow the loan generally do not afford the loan because interest rates are high. All right. So it cut down the money supply in the economy. Vice versa of it, if the interest rates are low, okay, it means that when the Reserve Bank of India reduces the repo rate, it means that the banks get the loan on the low interest rate so that they could lend it to the more and more customers because the customers find it attractive interest rate while borrowing the loan. Okay, this is about the interest policy. Secondly, what we have discussed the cash reserve ratio. Okay, and we have discussed the statutory liquidity ratio, right? So cash reserve ratio, we also called it as CRR, and for statutory liquidity ratio, we called it as a SLR. Okay, so the cash reserve ratio has to be maintained with the RBI, right? And the statutory liquidity ratio has to be maintained with the bank itself, right? Got it? We know that the bank could not directly lend out the entire amount it holds. Okay, like in the previous example, we had taken that the bank having 100 crores of rupees, and what we have discussed, that the bank could not lend out the entire amount as a loan because to fulfill its NDTL, NDTL known as net demand and time liability. Got it? So bank has to submit certain percentage as the form of CRR with the Reserve Bank of India, and we have seen that no interest provided to the bank by the Reserve Bank of India on account of submitting CRR. Neither the bank could use it for the further investment. All right. Whereas in the form of statutory liquidity ratio, the bank could maintain it in the form of cash, gold, or securities of government. Got it? So these are the things we have seen. And the last thing was the exchange rate. Okay, we have seen that generally the currency when in high demand and low supply. Second case is low demand and high supply. So the first case is the case of upgradation. Okay, and the second case is the case of degradation, right? We had discussed it. Okay, and the golden rule which we had discussed. Before that, one thing we have, first we have the weak currency, then we have the strong currency. Okay, weak currency promote exports, and the strong currency deals with inflation. How? We had discussed it in the previous lecture in detail. All right. So these are the things which we had covered in the last lecture, and this is a small recap of them. All right. Now let's start our journey with the reserve requirements. All right. So first is the reserve ratios we have. Central banks may require commercial banks to hold a certain percentage of their deposit as the reserves. Changing these reserve requirements can influence the lending capacity of banks and the money supply. All right, as we had discussed in the previous lecture. Okay, and let me give it an example again so that if you got a little bit confused in the previous lecture, so that right now you will get a clear-cut understanding of it. Okay, suppose 100 crores is the total deposits the bank have. Okay, if we talk about the general function of the bank, so what the bank do? They generally bank, these are the loans, these are the deposits. Okay, So the bank generally accept deposit and grant the loans. This is the basic functioning of the banks. All right. So when someone deposit the amount with the bank, the person is eligible to receive some interest from the bank. Suppose 6% is the interest the bank has to give to the depositor. Okay. And we know when we take the loan from the bank, we are liable to pay certain interest rate. Okay. So suppose 10% is the interest rate. Okay. So if you look at this picture carefully, what you will find, 10 minus 6 is the 4%. You can see that there is a excessive amount of 4%. Okay. So this 4% is basically the bank's income or profit, you can say. Okay. So the bank generally accept deposit and grant the loans. 6% chargeable on deposit, 10% on the loans. All right. This is the total deposit phenomenon. All right. So what is happening? The bank could not lend out the 100 crores as a loan to the borrowers. Why? Because as I have told you, the bank having the liability which we call NDTL, and full form is that net demand and time liability, right? Net demand and time liability. That's what we have discussed. All right. So basically, the bank has to maintain the certain reserve ratios so that it could fulfill this obligation. And these ratios are in the form of CRR and the SLR. Cash reserve ratio, statutory liquidity ratio. Okay, so suppose the cash reserve ratio is 4% and the SLR is the 6%. Okay, these ratios are generally decided on the basis of level of inflation and the deflation in the economy by the central bank or the Reserve Bank of India. All right. So if we go by the 4%, then the 4% of 100 crores is rupees 4 crores, right? So the amount of 4 crores will be deducted first. Okay. And when it's happened, how much left? 96 crores, right? And if we divided the 6% of 96 crores, what we will find? We will find nearly about, you can say 1.26 crores. Not 1.26 crores. It will be more than, you can say it's nearly about 8.36 crores. All right. Okay. So if we merge this thing, then we will find that it's a 12.36 crores. Okay. So if we deduct it from the entire value, then we will find 88.60, or you can say 54 crores. Okay. This is the remaining amount. The bank could use it for the lending out purposes. All right. So this is the reserve requirements. Okay. So now I hope that if might be in the previous lecture you got confused while understanding the example, now it is crystal clear to you. All right. So basically what makes the bank capable of to granting the loans and also maintain the NDTL, right? And this is basically decided by on the level of inflation or deflation. Okay. If there is an inflation, so the central bank will try to cut off the, you can say, money supply, right? So that's why they increases the CRR and the SLR. Okay, so if it increases, it means that the more amount has to be kept, or has to be keep as a reserve. Okay, which will ultimately minus the bank's capacity to lend out the loan, right? That's the first thing. Second is that if there is a deflation, so the central bank will try to encourage the banks to lend out more and more loan. All right. So what could be happen? That the CRR and the SLR will be decreased off. And when it decreased off, the amount which could be lent out as a loan would be increased automatically, and the more and more people could avail a loan easily. All right. And why we say that granting the loan to more and more people will increases in the money supply? Because as I have told you in the previous lecture, when the people get the money, okay, like again, let me show you. This is the bank. Okay, now this is the person. Okay, this person only having rupees 2 lakhs. Okay, but its desired is rupees 6 lakhs, or you can say its need, it's rupees 6 lakhs. Okay, so now if we look at this picture, what we will find out this person requires rupees 4 lakhs as a loan, right? Where to obtain these 4 lakhs? So the person could reach the bank. Okay, so when the bank will provide 4 lakhs to him as a loan, how much amount he has got? 6 lakhs. That was his requirement. Okay, so what he will do, he will spend it out. He will spend it out, or he will use this amount in the bank. So not in the bank, in the economy, right? So what was the golden dialogue we have learned in the previous lecture? That the one man expenditure is another man income, right? That's what we have learned. One man expenditure is another man income. Got it? So when he will expand the 6 lakhs, the 6 lakhs will be an income of the people. And when the people get income, they will spend it out. Okay, so automatically the money supply will be increased off. All right. But on the other hand, if you downgrade the supply, then it means that the 4 lakhs amount will not be granted to him, so that he could not spend it out. When there is no expenditure, there will be no income, right? So this was the picture. Thereafter, what we have the forward guidance. Okay. Central banks use forward guidance to provide information to financial markets and the public about their future policy intentions. All right. Why? Because the financial markets are generally involving in the lending out processes. All right. So if the central banks indicates them that the central bank is going to increase or decrease the repo rate, or you can say CRR or the SLR. Okay. So this will alert them about their policies which they are doing right now. Okay. Similar thinking, or you can understand it by, suppose if there is a financial market or the financial institution, okay, which is lending out more and more loan to the people. If they get an intention that the bank is going to increase the repo rate, so they know that in future, if they borrow the money from the Reserve Bank of India, they will have to pay the high interest rate, which will downgrade their profit. So what they will do, they will control their lending process. All right. Similar thing will happen with the public. If the person who requires a loan, he got an indication that the central bank is going to increase the CRR, the SLR, or you can say repo rate. So he got to know that in future, the financial institutions will not be comfortable in granting a loan. So he will apply for a loan nowadays, so that he could get a loan easily. All right. Clarity about future policies can influence expectations and the financial market behavior. That's what we have seen. All right. Thereafter, inflation targets. Okay. Listen me very carefully. that many times in the movies, or you can say in the news or whatsoever, you have seen the inflation as a evil. Okay, but the inflation is a good friend, right? Inflation is a good friend. Why? Because first, it's growth the economic growth. Second, generates employment. Okay, but now the question is how? If we go by the first term, economic growth. Okay, so what's happened basically? When there is inflation, there is a high corporate profit. Because right now the companies are getting higher amount for their products and services. All right. So this profit will be used by them to invest further. Okay. So that's how the economic growth could be brought up. Okay. And when they will be expanding off, they will require more and more manpower. All right. So that's how the employment creates. Okay. So inflation is good until or unless it is in a controlled manner. Once it get out of control, then there will be a case of excessive inflation. Okay, and this will not be in a favor of our country. All right, so that's why the central bank could not directly avoid the inflation, because as I told you, inflation is good as far as we consider the economic growth, okay, and the employment part. All right, so that's why we basically, you can say, set the target of inflation. Okay, like we have to maintain this particular inflation during this fiscal year. And if we talk about the year, then basically there are two types of year: calendar year, all right, and then we have the fiscal year. Okay, our calendar year started from January to December. All right, our fiscal year is from April to March. Okay, so when we talk about the economic activities and others, basically we do not go by the calendar year. We generally go by the fiscal year. Okay, so the inflation targets are basically decided for the fiscal years. It means from 1 April to 31st March. During between these timeline, we have to maintain the particular inflation target in our country or economy, and we called it as an inflation target. All right. Many central banks have explicit inflation targets. They use monetary policy to achieve and maintain these targets. If inflation is above target, the central bank may raise interest rates, and if it's below target, rates may be lower. All right. It means that suppose if we have decided that the 6% should be our inflation target, right? That's what we have decided, that we have to maintain the inflation at 6%. Now there are two cases. First case is for the excessive targets. Okay. Second case is for our lower targets. All right. If there is an excessive target, it means that already inflation has crossed the boundary line. So what will happen? High repo rate, high CRR, high SLR. Why? we have to cut off the money supply. When there is a lower targets, it means that the inflation level is below the setting or below the target. Then what will happen? Repo rate will be downgraded, CRR will be downgraded, SLR will be downgraded. Why? Because now we have to increase the money supply. Okay, so this is what we call as a inflation targets. All right, and it is generally decided on the inflation basis, like what is the level of inflation. Thereafter, we have economic data indicators. Okay, central banks closely monitor economic indicators such as GDP growth, unemployment rates, and the inflation level. Changes in these indicators can influence the monetary policy decisions. All right, this is very, very important. All right, suppose if there is a low GDP growth rate and high unemployment rates, generally what will happen? The central banks increases the inflation. Why? Because as I have told you, the inflation having a good effect on two things. The first is the unemployment rate. Second is economic growth. And how it is possible, I have told in the previous lecture, in the previous slides, not lecture, in the slides. All right. But if there is high inflation, it means that it has crossed target limit. Then what will happen? Generally, the central banks, you can say, apply the cut down monetary policy. It means they will cut down the money supply. Okay. In case of these one, they will increase the money supply. All right. Thereafter, what we have the inflation expectations. What do you mean by this? Central banks also consider the inflation expectations as they can influence actual inflation. Anchoring expectations at the target level is a key goal. Okay. Not only they focus on these parts, but also they focus on the inflation, current and the expected ones. Thereafter, what we have the asset bubbles. Okay. In the stability or the financial stability part, central banks may take action to address the asset price bubbles, such as real estate or the stock market bubbles, which can pose risks to the financial stability. Like it means that the price of the stock or the property is not as per the requirement. Okay, like you can say, if there is a stock or the properties which is actually worth of rupees 10 lakhs. Okay, but due to under influence of economic factors like inflation and false marketing, it is posted as rupees 15 lakhs. Okay, so however, the person will purchase it on 15 lakhs, but the actual price was only 10 lakh, right? So it will be a risky for the financial stability because the purchaser would not be able to sustain it for a long. Thereafter, banking system stability. The stability of the banking system is a concern for the central banks. They may use monetary policy tools to support the banking sector during times of crisis. Why? I have told you in the form of IRP, repo rate, CRR, SLR, and the open market operations, as well as the exchange rate part. Thereafter, what we have the globalization and the global economic environment, because nowadays when we talk about the economy, we are not talking about the closed economy. Economy is open for all right? So we have to maintain the global scenario as well. Central banks are mindful of global economic conditions and external shocks as they can affect a country's economic outlook and the financial stability. All right, because right now every economy is dependent on the other economy, or you can say there is a cross dependence on the world economy part, right? Global interest rate. Changes in global interest rate, especially those set by major central banks like the US Federal Reserve, can influence capital flows and exchange rate. Because when we talk about the exchange rates, basically we're talking about the US dollar or the USDs, and these comes under the US central bank, which is known as the Federal Reserve. Okay, so anything done by the US will ultimately changes the dollar supply in the international economy and affects the capital flows and the exchange rates. All right, then coordination to the fiscal policy. Fiscal policy we will learn in the next class. Okay. There is often coordination between the monetary policy controlled by the central bank and fiscal policy controlled by the government. Fiscal policy, which involves government spending and taxation, can impact overall demand and inflationary pressure in the economy. All right. About fiscal policy, we will discuss in the next lecture. Till then, just keep this point in your mind. Okay. And you will be get it cleared in the next class. Thereafter, political factors. What are these? First is the central bank dependence. The degree of independence of a country's central bank from political pressure can influence the effectiveness of the monetary policy because it will ensure the non-corruption, openness, and the fairness and integrity. Alright, so it is very, very important that the bank should remain independent. Political stability. Political stability and the credibility of the government policies can affect market expectations and confidence in the central bank's policies. Why? Because as I have told you, or we have seen basically, that the monetary policy of the central bank and the fiscal policy of the government, they both are independent to each other. So if the government got changes, then the fiscal policy will be changed by the new government. So ultimately the monetary policy has to change a lot. Okay, so there will be a disbalance. So that's why the political stability has to be maintained so that the stable fiscal policy will be there and then the stable monetary policy will be there. Okay, so we have finished. Right now we have finished this monetary policy. Okay, so please keep all the things in your mind and revise the lecture well before you have come for this lecture. With this note, let's end this lecture, and what we say thank you.